It's 2004. Two mates, the same age, earning the same income, made two completely different decisions. Jim bought a house in Elwood for $78,000, exposed brick, tiny backyard. His mates laughed at him. He took on a second job to pay the loan. He ate baked beans more nights than he'd admit. No Bali trips, no weekends away. His mate kept renting a nice apartment. Friday drinks, the whole lot. From the outside, he looked like the one who had figured it out. Today, Jim's house is worth $2.5 million. He's retired. His mate is still renting with two kids, competing for properties he can't afford. Jim made one decision at 25, and it's one that everyone around him called a mistake. I've sat across from both sides of the gap more times than I can count, and the pattern never changes. It's not luck or even income, it's timing and what you're willing to trade for it. This video will show you exactly what that trade was, the trap that's quietly pricing anyone still waiting for the right time, and the 2006 version of that same move, because it's not baked beans anymore. It's more achievable than what Jim did, and most people don't even know it exists. Let me be honest about something. I'm not someone to shame anyone who rents. Renting isn't the problem. What you do with your money while you rent is the problem. The older generation stamped this idea into everyone's head that rent is dead money. And honestly, that's a half truth, and it's been keeping more people stuck than almost anything else I hear. But rent isn't dead money if you're investing somewhere else. Shares, property, crypto, anything. You still need somewhere to live. The waste isn't the rent check. The waste is renting and traveling and spending money on things you don't actually need and saving nothing. I had a couple come to me recently, both living at home in a granny flat, paying zero rent. They thought the smart move was to buy their first home together in Sydney. That's what everyone told them to do. Get on the ladder, buy where you live. We sat down, we went through their goals, and I said, what if you didn't do that? They looked at me like I was insane. Instead of buying one $900,000 property in Sydney, they purchased 3 investment properties across regional Australia. They kept living at home, no rent. All 3 properties are now tenanted, building equity and generating rental income. When they're ready to buy their family home, they'll have the equity from those 3 properties to either sell or leverage. They didn't sacrifice their lifestyle. They just redirected where their money went. That's the difference. The generation who ate baked beans understood something most people still don't. It was never about suffering. It was a financial strategy. And the people who did it quietly are now $1 million ahead. Now let me tell you about the trap that catches almost everyone I work with. I had a client, let's call her Sarah, and she did everything right. She saved every week and didn't go out. She didn't have that weekend avocado toast. She was targeting a property at around $750,000. 3 months later, she'd saved a solid chunk, but the properties she was looking at, they weren't $750 anymore. They were selling for $800, some $850. So she adjusted, started looking at new suburbs. By the time she could afford those suburbs, they'd moved too. It becomes this vicious cycle. Every time she caught up, the goalpost had shifted further than she could save. I see this constantly. And the most dangerous sentence I hear in my office is, I just need to save another $20,000 in the next 3 months. Sounds reasonable, right? Sounds responsible. But the market doesn't wait for your savings plan. I use a tool with my clients that shows exactly what properties in their target suburbs have done over the last 12 months and what they're projected to do in the next 6. And when you see the raw numbers, it hits different. In some Sydney suburbs, properties grew $40,000 to $68,000 in 12 months. And they're projected to grow another $30,000 to $40,000 in the next 6 months alone. Can you outsave $40,000 in 6 months? Most people can't. And that's the moment it clicks. You're not being patient, you're being priced out. And those two things feel identical until it's too late. This is where the older generation's advice actually hurts people. Save 20% before you do anything. That was the rule. And it makes sense when houses cost $200,000. But when the median price in Sydney is pushing $1.5 million, 20% is $300,000. That's not a deposit. That's a decade of your life. I had a client who was adamant they were not going to take out mortgage insurance or utilize any government schemes. They were going to put down the 20% or nothing. So I asked him, how long will it take you to get to 20%? About 4 months, he said. We pulled up the data on his target suburb. That area was outpacing his savings by 6 to 8 weeks. The gap continued to grow wider than what he could save in 4 months. The maths literally didn't work. So we had a conversation about LMI, lender's mortgage insurance. Most people see it as a waste. But what if you looked at it as a vehicle? A leapfrog into the market? Yes, it costs you thousands of dollars. But if the alternative is watching properties appreciate $40,000 while you're still saving, which one is actually the waste? I had another client with a 15% deposit who wanted to throw everything at the purchase to avoid LMI. We actually told her to put down less. She paid maybe an extra $1,000 to $2,000 in LMI premium, but she kept a 5% cash buffer for emergencies, for vacancy periods, and for peace of mind. That small decision, paying slightly more in insurance to keep the cash in reserve, meant she slept at night. She didn't panic sell 6 months later when her hot water system broke. The calmest buyers I work with aren't the ones with the biggest deposits. They're the ones who started early, got their building and pest done first, and didn't try to negotiate on price before they even knew what they were buying. So what does sacrifice actually look like in 2026? Well, it's not baked beans. It's not working 2 jobs. It's this. Stop spending on things you don't actually need. I know that sounds simple, but when I sit down with clients and we go through their expenses, the amount of money leaking out on subscriptions they forgot about, on impulse purchases, on things that felt important in the moment, but added zero value to their life. It's staggering. The modern version of sacrifice is buying within your means and choosing a 10-year loan term instead of a full 30-year term. It's finding the right property at the right price that fulfills your needs and not your ego, and then attacking that debt. The single most powerful thing I see my clients do, additional repayments every week, as little or as large as possible. That's the unsexy, invisible decision that quietly compounds into hundreds of thousands of dollars over 15 years. The clients who built serious equity fast versus those who didn't, the difference had nothing to do with income. It had nothing to do with the property they bought. They sacrificed. They bought in the areas that most people didn't want to because they could see the future value. And they made extra repayments like clockwork. I had a client come back to me years later. They wanted to sell their property because they couldn't afford the repayments. We restructured their debt, made it more comfortable for another 3 years, and in those 3 years, the property saw a huge spike in growth. When they eventually sold, they walked away with profits they would have completely missed out on if they had panicked and sold when it felt hard. That restructuring decision, the one that they didn't fully understand at the time, changed their financial future. If I could sit across from a 25-year-old who's comfortable renting and genuinely happy, I wouldn't try to scare them. I'd just say this: start investing in property. You don't have to live in it. You can keep renting where you love, but start building wealth now, because the sooner you get in, the sooner you start making real wealth. And I'll die on that sword. The generation that ate baked beans wasn't noble. They weren't martyrs. They were running a strategy that most people around them didn't understand. And 20 years later, the results speak for themselves. The question isn't whether you can afford to buy. It's whether you can afford to keep waiting. Now, if you're just sitting under the borrowing limit right now and you're not sure whether to wait or move, you need to understand what the new DTI rules mean for your borrowing power, because everything's about to change. Watch this next. And if you're looking to optimize your mortgage pathways, let's chat. Links in the description.